The Federal Reserve raised interest rates by 0.75 points, the fifth rise of the year, in reaction to the inflation rate's 8.3% increase this year. The CEO of ARK investment and financial expert Cathie Wood, however, thinks that the Fed may be mishandling inflation in this manner and that the organization may be omitting some crucial information in the process. Welcome back to Everything, guys. Tesla shares. The Federal Reserve has consistently declared its commitment to reducing inflation rates as much as it can. Although interest rate rises normally occur in increments of 25 basis points, the U.S. Central Bank recently announced a third consecutive 0.75-point rate boost, pushing rates to a range of 3 to 3.25%, the highest level since 2008. The Fed appears to be taking severe measures to lower the inflation rate, which is significantly higher than its benchmark target of 2%. In response to the announcement, Wood said that while the Fed might view this as an effective way to fight inflation, the effects of this action might seriously harm the economy. Why did Wood make this statement, and what consequences could this Fed interest rate increase have? Before we get started, don't forget to like, subscribe, and enable notifications so you can be informed about what Tesla is doing by raising the interest rate. In order to reduce inflation on the prices of goods and services, the central bank intends to discourage spending. However, this will have unintended consequences, including raising home equity loans to 8% and possibly increasing monthly payments for new or variable rate mortgages. Despite Wood's belief that inflation is to blame for the economy's sharp decline, the financial expert also believes that companies are also likely to suffer the heat of deflation, and this is a problem for investors to be worried about. No doubt inflation is hitting hard on the economy, but this time it's not as a result of the usual causative factors, but rather a product of major economic shocks that have never been seen before. Unlike in previous times, square factors, like the crash in dollar value and oil prices, caused inflation rates to spike. The case is quite different now, as issues like the pandemic, the supply chain problem, and the Russian-Ukraine war are all major contributors to inflation. This is not the first time Wood is revealing her concerns about deflation. When she previously spoke about the subject, she claimed that 50 of the S&P 500 is at risk of creative destruction, and most companies, especially automakers, are unprepared for the effects of deflation. Wood added that automakers could suffer bad deflation, as well as commodity deflation, if proper steps are not taken in 2021. The stock investor warned that deflation rather than inflation will be the largest risk of financial markets and the economy in the coming years. Wood predicted that the U.S. economy will expand less than many experts anticipated in the upcoming year. Although the Fed's primary worry is deflation, there might be some other aspects of deflation that go unnoticed. Deflation may begin to creep into the economy, as shown by a number of indicators, one of which is the used PAR index. The Mannheim Used Vehicle Value Index dropped to 204.5, and the gate of the value is now down 0.1% from 54 about a year ago, according to the report. Wholesale used vehicle prices declined by 3% in September compared to August, and it is estimated that used car retail sales fell by 8% in September compared to August and by 10% over the course of the past year. On the bright side, it could be a bad market for the ICE car market, but it might be an opportunity for electric vehicles to take over since they're becoming easier to maintain and there are new policies to promote these vehicles. This isn't because there's more production of these cars, but because they are becoming increasingly difficult to maintain. Additionally, based on Wood's earlier talk of inflation, innovation might be what saves EV companies. According to Wood, automakers will undoubtedly struggle after inflation's creative destruction, and businesses who are focused on the short term and investing less in innovation may find it challenging to stay up with the upcoming market challenge. The same goes for automakers that produce drugs that could eventually become outdated. Otherwise, they risk suffering a huge loss. The focus will move to companies that can expand regardless of the economic climate, since Cathie thinks that only businesses with a competitive edge in innovation can prosper amid the anticipated deflation. She anticipates to decrease economic growth. Given how innovative Tesla has been, Tesla balls will probably sigh with relief at this point. Do you share my opinion? Please let us know in the comments section, and if you haven't already, like and subscribe to the video. Even while the Fed asserts that its strategy is data sensitive, few financial specialists like Cathie will buy it. The Fed's speech, according to Paul Kroltz, portfolio manager at Kingsview Investment Management in Chicago, was quite hawkish. He said that the increase in price is a sign of market volatility and a significantly higher likelihood of a recession over the next 12 months. It was a pretty hawkish 75 basis point increase, according to Ryan Detrick, chief market strategist at Carson Group Omaha, and the Fed left the door open for even more rate hikes before the end of the year. The dots plots show that there will be more hikes than initially anticipated, and the Fed is prepared to hurt the economy and possibly the stock market in order to stop the runaway inflation we've witnessed this year. Detroit claims that the Fed's predictions for the economy are extremely underwhelming and that the economy is already slowing down significantly. He continued by saying that the Fed's stance on interest rates might push the dollar higher and put additional pressure on stocks. Music, however, the Fed does not appear to be giving up on its pursuit of power anytime soon, according to Federal Reserve Chairman Jerome Powell, who stated that the institution is committed to maintaining its stance until it is certain that inflation rates are declining. He stated that inflation is running too high, and if that is all you know, you can be confident that this committee is committed to reaching and maintaining a meaningful restrictive stance on policy. Additionally, a number of Fed members have stated that before there can be any talk on easing the policy, they need to see consecutive months of inflation rising towards 2%. In a recent interview with Bloomberg News, Mary Daly, the president of the San Francisco Federal Reserve, discussed this. She said that additional policy changes will be needed to adequately restrain the economy. She envisions that Fed raising rates to a level that she believes is restrictive enough to lower inflation and then holding it there, even though the Fed's current target range for its benchmark rate is 3 to 3.25%. Governor Christopher Waller reaffirmed this, saying, "Until we see any signs of inflation beginning to moderate and don't know how we pause, while there is a lot of optimism that inflation is gradually easing, Fed doesn't seem to be anywhere near backing out of its plans, even with the risk of an economic downturn. The U.S. Central Bank could be on a course to deliver a fourth straight 75 basis point rate increase in the future."